Okay, so imagine someone tells you we are on the verge of an economic boom bigger than anything the world has ever seen. It's a massive claim, right? But that's the exact prediction we're digging into today. We're going to break down a really specific argument for why the year 2026 could be one for the history books, and it all boils down to three huge forces: interest rates, government stimulus, and a sort of hidden safety net for the market. So let's jump right in.
So it all starts with this statement: an economic boom the likes of which the world has never seen. I mean, wow, that is a gigantic promise. But a claim that big, well, it needs a pretty serious foundation to stand on. So what's the thinking that could actually get us there?
And that's really the big question, isn't it? Why 2026? What is so special about that specific year? Well, according to the source material we're looking at, the entire argument is built on three main pillars, and we're about to walk through them, one by one.
All right, reason number one: the expectation of much, much lower interest rates. Now, that's a classic way to get an economy going, but it's the timing of it all that makes this argument so interesting. And to really get why, we need to quickly define a super important term.
And that term is the federal funds rate. The easiest way to think about this is like the wholesale interest rate for the entire financial system. It's not the rate you pay on your mortgage, but it has a huge influence on it. This is the rate banks charge each other for overnight loans, and it's the main lever the Federal Reserve pulls to steer the whole economy.
And here's exactly how that works. On one side, you have that wholesale federal funds rate. When it goes down, it gets cheaper for banks to borrow money. And because their costs are lower, they can then offer cheaper retail rates to us, for things like car loans or mortgages. Lower rates usually mean people and businesses borrow and spend more, and that's basically the fuel that gets the economy humming.
So this brings us back to the timing. Why 2026? The source points to one specific date, May 15th, 2026. That's the day the current Federal Reserve's chair's term is up. The whole argument here is that this opens the door for a new Fed chair to be appointed, someone who might be in favor of cutting interest rates and cutting them aggressively, which would push that wholesale rate and, by extension, all our retail rates way, way down.
Okay, let's move on to the second reason, because this is where things get even more interesting. It's not just about cutting rates. The source argues that this boom will be kicked into overdrive by a huge and kind of unconventional way of government stimulus. And no, we're not talking about the stimulus checks you might be thinking of. This is different.
This stimulus is described as a three-part attack. First, you've got targeted policy changes designed to boost very specific industries. Second, a return to printing money on a massive scale. And third, a huge amount of government spending that goes way beyond what it brings in from taxes, what we call deficit spending. Let's break each of those down.
So the first piece of this stimulus is very strategic. The source highlights that the government won't just be easing regulations to help key areas like rare earth metals or AI and data centers. It's also expected to do something pretty unusual: directly invest taxpayer money into specific companies working in these fields.
Now let's talk about the money printing. The source points to what it sees as a critical turning point, December 1st, 2025. This is flagged as the moment the Fed stopped its quantitative tightening policy. That's just a fancy term for the process of pulling money out of the economy to fight inflation. According to this theory, that's the day they flicked the switch from taking money out to pumping it back in.
And just how big of a switch are we talking about? Well, the source claims that after this policy change, the Fed committed to creating an extra $40 billion every single month. Now, all that new money has to go somewhere, right? And the core argument is that a whole lot of it is going to flow right into the financial markets.
And this leads to a pretty controversial part of the argument, which is all about inflation. The claim is that this level of money printing creates a kind of wealth transfer. See, on one hand, regular consumers end up paying more for goods and services, but that extra money has to go somewhere and it flows to businesses as revenue. And since investors own those businesses, they end up capturing those higher profits, which in turn pushes up the value of their assets like stocks.
The last piece of this stimulus puzzle is the deficit spending. The source projects that in 2026, the government will spend $2 trillion more than it brings in through taxes. That massive amount of borrowed money gets injected directly into the economy, funding everything from infrastructure projects to government salaries. And it all acts like a powerful booster shot for corporate revenue.
So we've got lower rates and a tidal wave of stimulus. But according to the source, there's a third really crucial piece to this whole thing: the idea of a hidden safety net, or what you could call a backstop for the market.
So how does this backstop actually work? Well, that huge $2 trillion deficit has to be paid for, and the government does that by selling debt. But here's the kicker: what happens if there aren't enough buyers for all that debt? The source claims
That's when the Federal Reserve just steps in. It becomes the buyer of last resort by printing whatever money is needed to buy the debt and fund the government's spending. It creates this powerful, self-reinforcing loop.
And this quote from the source material really just sums it all up. The argument is that these interlocking mechanisms, the Fed funding the government, which then stimulates the economy and pumps up asset prices, have created a system that is fundamentally designed to support, protect, and backstop the investor.
Okay, so if you buy into this whole three-part argument, lower rates, huge stimulus, and a market backstop, the next question is, what does that mean for an individual? Well, the source doesn't just leave us with a theory, it lays out what it calls an investor playbook for this potential future.
And the playbook's core idea is actually pretty simple. Just follow the money. For anyone looking for broad exposure to a rising market, the source points to basic ETFs. But for a more targeted strategy, it comes right back to those strategic sectors we talked about earlier. The ones getting direct government support and investment, like rare earth minerals, and the companies building the infrastructure for AI.
And that really brings us to the final takeaway question. We've just walked through a very specific argument that a powerful combination of policy, stimulus, and support is being lined up to potentially create a major boom in 2026. The source makes a strong case that money tends to flow where policy leads it. So the question it leaves us all with is, if that's true, where will you be standing?